What should Chinese investors be focused more on? Is it more about trade, this Trump Xi call, Hong Kong protests, trade talks? What are you looking at?
Yeah, well, I think for the mainland investors, in the near term, trade talk is probably more important. I think the market sentiment is looking for at least a patch-up deal between China and U.S. And it seems that Trump, under all this various pressure, is eager to make a deal, even though it's only a short-term patch-up deal. So I think the domestic investors are really looking for some sort of a clue, a pointer, regarding the progress in the trade negotiation.
But it's not going to be sustainable, right? Even if we get a mini deal, in terms of giving the market a platform and then a further platform to sort of climb.
Yeah, I think the two sides are really too far apart. I think China wants a partial deal to put it temporarily aside, and then the U.S. wants a comprehensive deal, including a regime change even. So I think the two sides are really too far apart for a comprehensive deal, but market is hoping for at least a patch-up deal.
Yeah, I was looking at your notes, and the one thing that you're looking at is the 850-day moving average for the Shanghai Composite. So it really goes to show you have a really long-term view when you look at the Shanghai Composite. Why is this technical so important to you in forecasting the Chinese market?
Yeah, I think if you put the 850-day moving average and the Chinese short-term economic cycle together, you can see 850 days really is a 3.5-year cycle, which coincides with precisely with a Chinese short-term economic cycle. So right now, if you look at the moving average, 850-day moving average is really right. The index is running really right into the strong resistance level. And that's why, from an asset allocation point of view, unless there's substantially good news that is way out of expectation, it's unlikely to, to break through this.
Yeah, and we have it on our terminal here, just in case, of course, just for viewers to see. Tom, go ahead.
Yeah, Hao Hong, just to bring some optimism to play here, you do talk about a China or a new bull market in China, but it sounds like it's a long way off. So you have to break through that resistance level of 3,200, and you need additional liquidity. Is that the key catalyst to get that bull run in Chinese equities?
Yeah, I would say, for the Chinese equity to run, to push up further from here, new source of liquidity is necessary. The problem, with the Chinese market is that the central bank this time around is not doing strong monetary stimulus. The economy is slowing down, and then the Chinese investors are saving less. Basically, if you look at the macroeconomics account, if you look at the current account to GDP ratio, probably for the first time in the last 10 years, the current account to GDP ratio is very close to zero. So that is showing you that as a nation, the Chinese has stopped saving. So the liquidity available for the stock market is actually dwindling. So there's a new source of liquidity that is required. And I think most likely it will be a foreign inflow into the Chinese equity market.
And what kind of time frame are we looking at for that?
Very long, very long. I think the market is, starting to open up, and also, because of the trade negotiation with the U.S., it actually accelerated the opening process. But then at the same time, from a foreign investor's point of view, especially looking at the Chinese equity market, there are a lot of hidden rocks in that market. Corporate governance, just to name a few. So, if you look at the foreign inflow to the Chinese bond market, that's a different story, all right? So, because the bond market is of very good credit, and also most of the bonds issued are backed by some sort of a Chinese government credit. So, as a result, in the past 2 years, the foreign inflow to the Chinese bond market has more than tripled in a very short time span.